Because the investment landscape is dynamic, it makes predictions quite difficult. However, there are a few constant truths that even a beginner investor can understand without too much work, resulting in real growth in the longer term. A good point to start would be to understand the investment risk ladder. Different types of investments carry different risk profiles, which you should take into account when you make your investment decisions.
The major asset classes and investment vehicles on the investment risk ladder in ascending order of risk are cash, bonds, pooled investment schemes like mutual funds, ETFs, unit trust, etc., equities, and alternative investments. Let's look at each of these in greater detail.
Number 1, cash. Cash in the bank is where it all starts. This is where you can first see your savings once you start to spend less than you earn. It is not only the easiest asset class to understand, but also the place where your money is the safest. Although the earning potential is lower than the other asset classes, you know exactly how much you will earn in interest every month, and you are sure that you will get your capital back. However, because bank interest rates are typically low, the growth of your money will struggle to beat inflation. It is therefore advisable to only keep enough cash for liquidity to do your monthly shopping and as a buffer in case of emergency. For higher interest rates in a cash instrument, one can look at certificates of deposit, CDs, but they are less liquid, with penalties for early withdrawals.
Number 2, bonds. The best way to describe a bond is that it's a loan that you as the investor make to a borrower, the entity that issued the bond. Now, bonds are mostly issued by government or corporations. Bonds are used by these entities to make purchases to grow the business, to finance the operations, or for expansion projects. Bonds usually have a fixed interest rate. Now, although variable and floating interest rates are now more common, it's paid to the investor at regular intervals. The primary investment is paid back to the investor at the end of the investment period.
Number 3, pooled investment schemes. Pooled funds are funds in a portfolio from many individual investors that are aggregated for the purposes of investment. Mutual funds, hedge funds, exchange-traded funds, pension funds, and unit trusts are all examples of professionally managed pooled funds. Investors in pooled funds benefit from economies of scale, which allow lower trading costs per rand or dollar of investment and diversification. A good example of pooled investment schemes is a mutual fund. When you invest in a mutual fund, you pool your money with many other investors. These funds are managed by fund managers or portfolio managers. These portfolio managers then take the pool of money and invest it in equities, bonds, and other securities.
Mutual funds are split up into 2 broad categories: passively managed and actively managed. A passive fund manager buys assets and keeps them in the hope of achieving the fund mandate. For instance, a JSE Top 40 fund will only contain the top 40 equities on the JSE. The composition of the fund's asset allocation will only change if the stock enters or leaves the JSE Top 40. Another good example of pooled investment schemes is exchange-traded funds, ETFs. ETFs offer another good way to diversify your portfolio without making many individual investments. Their rise in popularity since their inception back in the mid-1990s means they are now popular components of the most well-diversified portfolios. They consist of a basket of shares much in the same way as a mutual fund. The big difference is that they are listed on a stock exchange and are therefore traded throughout the day, which means that their value can fluctuate quite a bit in a short time. Just like mutual funds, they consist of a basket of shares, and investors can choose from a broad range of ETFs with different share allocations to bring diversity to their portfolios.
Number 4, equities. Companies list on stock exchanges and sell equities, or shares, as one of the ways to raise funding for these businesses. The people who own these equities are then able to share in the company's success through growth in the value of the equities, as well as through dividend payouts. You, as a shareholder, do not own the assets of the company, but do have a claim if the company ever goes bankrupt. Shareholders can also vote at shareholder meetings, and there's also a specialist class of equity known as preferred equity. If the company only has limited resources available to pay dividends, preferred stockholders get paid first.
Number 5, Alternative investments. Alternative investments are all the investments that do not fit into the previous categories. As such, there is a wide array of investments in this category with varying risk profiles. Here are the major subcategories. Real estate. There are several ways in which investors can start to build up their real estate portfolios. When you are further down the path towards financial freedom on your map, you may be able to purchase residential or commercial properties outright. In the meantime, it is possible to gain exposure to the real estate market through real estate investment trusts, REITs. They work just like collective investment schemes, where your money and that of other investors is combined to invest in a property portfolio.
Hedge funds. Hedge fund mandates provide the fund managers with a wider toolbox to generate returns. Return profiles can range from targeting to outperforming equities to a stable cash plus return profile. The benefit of a hedge fund mandate is that it can be used to generate returns uncorrelated to other asset classes in rising, falling markets. Hedge fund managers can make use of leverage, short selling, and concentrated positioning to generate these returns. Hedge funds are usually high investment minimums and long investment periods. The complexity and unique mandate of a hedge fund results in it being classified as an alternative investment.
Private equity fund. Private equity funds offers investors access to company shares that are not listed on exchanges. These funds often employ staff members with expertise and experience in putting businesses on a high growth path. These funds typically invest in promising businesses that can provide excellent returns for investors. However, just like hedge funds above, there are usually high investment minimums and long investment periods. Commodities. Commodities are all physical products like gold, platinum, oil, corn, wheat, and the like. There are many different ways to invest in commodities. You can own the physical assets, such as gold. You can also invest in the future worth of a commodity, such as the future price of maize on the South African Futures Exchange, SAFEX. You can also invest in commodities through funds of pooled investments, known as managed futures funds. There are also ETFs that focus on commodities.
The 6 categories mentioned above provide a basic breakdown of the asset classes that are open to investors. As you can see, there are quite a few investment options, which may seem overwhelming to new investors. However, by segmenting them in this order on the investment risk ladder, you can buy the right investment and take on the right investment risk levels for where you are on your map journey. New investors can start at the bottom of the ladder and then slowly work their way up as they build their portfolios.